Hey everyone, my name is Andy Bromberg. I'm the co-founder of CoinList, and CoinList is a platform where the best digital asset companies manage their token sales and where investors find quality deals in the space. We've worked with companies like Filecoin and Blockstack, Basis and Orchid, and many others, and more than $500 million has gone through our platform in token sale funds since we started about 8 months ago, so really significant funding through the platform. But that's actually not what I'm here to talk about today. We'll mention briefly some of the services we offer, things like compliance services and these sales services, and our new service helping with airdrops. But I'm here to talk about the ICO market and how we're going to fund the future with ICOs this year and moving forward. We're going to talk a little bit about the rise of ICOs over the course of the last year or two, and then we'll talk about how you should be doing your diligence on these ICOs as a potential customer, investor, team member, and more. Then we'll talk about some new models for ICOs and token distribution, followed by talking about security tokens and this new trend that we think is going to happen in a really meaningful way towards the end of this year and early next year, how you should think about that, and then a brief wrap-up on the industry as a whole, and we'll go to some questions. So without further ado, the rise of ICOs. I think everyone in this room probably knows about this, but just to put some numbers on it, there's been a massive rise in the past couple of years in ICO funding. We look at this. This is January 1st, 2016, a great chart from elementus.io on the rise of ICO funding. This is the total funding as of January 1st, 2016, $45 million, with Ethereum being the biggest at about $19 million. 1 year later, January 1st, 2017, we were up at $320 million, about a 6x improvement over that. The DAO, of course, raised more than $150 million. There were a number of other projects that raised money. This is January 1st, 2017. And not even a year later, November 30th, 2017, this is what the market looked like. More than $6 billion raised. And this is colored geographically. You can see actually Europe there in blue, North America in orange. We were seeing a massive 20x increase in ICO funding in even less than a year here. And this year is trending even better. We're halfway through the year. We've seen about $9 billion in ICO funding, and we're seeing no signs of that stopping anytime soon. So with this rise, how do you look at these projects? How do you do your diligence and decide which projects you should invest in, you should work for, you should use? And we like to break it down into a few things here at CoinList. And to give you a sense, we see diligence as really one of our core competencies. We've worked publicly with 4 sales at CoinList over the course of the last 8 months, and we have had more than 1,800 sales inbound asking us to list their sale. 4 out of 1,800. And so the diligence here is incredibly important to understand which sales are high quality and which are not. First up, I think people forget this, but the first thing you can do when you look at a token sale or look at a token project is classic startup diligence. The same things you would look at if you were evaluating any startup in any industry. That's looking at things like the team. Is it a high-quality team? Have they shipped product in the past? Do they have a real sense of leadership and a sense of accountability and ethics? Exact same things you look at when evaluating a startup. Second, the market. Is there actually an addressable market for what they're building? Can you see a world where this product has massive uptake and the token is addressing a large problem? Third, the product. Are they building a product that end users or consumers are actually going to want to use? So often we see really interesting products, really interesting tokens that have some cool intellectual ideas, but there just seems to be no path to a product that anyone will actually want to use at the end of the day. And that's incredibly important if these tokens are going to attain any sort of meaningful value. And fourth, the deal. This is forgotten so often. What are you actually investing at? What is the valuation you're looking at? How many tokens are you getting if you're joining the team? What are you getting if you're participating as a consumer? The deal here is underrated, and most people don't even really know the terms that they're getting involved at in the token industry. And you have to take a step back and say, what is it that I'm getting? What are the comparable things I could be looking at? And how can I make that equation make sense for me? But on top of all of those things, there's a new thing you have to evaluate when you look at tokens, and this is token economics. This is kind of a new term, and it's something that there isn't a lot of expertise on right now because we're so early in the ICO industry. Token economics refers not to the deal, which I just talked about. It doesn't refer to the price of the token. It refers to the internal token economy. Are the parties that need to be properly incentivized for this token network to work properly incentivized? Are the bad actors that could be involved in this network properly disincentivized from messing with the network? To give you an example, we think about Filecoin a lot, which was the first sale we ran on the platform. It raised more than $205 million. There are 3 parties on Filecoin that are really important. There are people who have files that they want to store. There are people with storage space that they want to use. And there are people that are verifying that is all happening correctly. All 3 of those parties in Filecoin's model have to be properly incentivized by the token economics, by the way the network actually functions, in order for Filecoin to see success. And on top of that, there are potential bad actors, liars, frauds, scammers that could participate on the Filecoin network. And those parties need to be properly disincentivized. They need to see penalties from the network for doing the wrong thing. And that token economic model is so important. We so often see projects that are 95% of the way there on the token economic model, but they're missing one key piece. That one key piece could, again, be someone that needs to do the right thing that isn't being incentivized properly. It could be someone that can't do the wrong thing that isn't being properly disincentivized, but that is something you absolutely need to look at when you're evaluating these projects. But on top of this, we look at ICOs and we realize that new models are emerging. As we saw the ICO market really only a year or two old, we can say without a doubt that we have not found the perfect models for token sales yet. We are still searching for them. They've worked well, but we can get even better. One of the models that we think is really interesting is what are called airdrops. Airdrops are a way of freely distributing tokens to the consumers of a network. You can almost think of PayPal back in its early days as doing the original airdrop when they gave $10 of PayPal credits to anyone that signed up for PayPal. They were getting people on the network, incentivizing them to sign up, giving them a currency that they could actually use on that network so those people could become addicted and want to use it over and over again, deposit their own money. That exact same thing is starting to happen in the world of tokens. Bootstrapping community adoption by airdropping to targeted sets of users and giving them a chance to participate without needing to commit their own capital to the project. You'll hear in a couple hours, if you stay at the stage, from Dom Williams, who is the founder and CEO and chief scientist of a project called Definity. It's an incredibly cool project, a decentralized internet computer. And CoinList is actually helping with their airdrop. It's the largest ever. They're airdropping $35 million worth of tokens to users and community members of Definity and CoinList. That's incredible, and that's going to give them initial adoption that they need in order to see success. But they're also fundraising separately. They're raising from some of the best investors in the world to give them the capital that they need. So I think we're going to see this decoupling of fundraising and distribution in a really meaningful way. Another model that's emerging that we're seeing a lot of now is tranched fundraising or milestone-based fundraising in ICOs. In 2017, every ICO, they raised money and they said, we're probably never going to raise money again. This is all we need. But that doesn't necessarily make sense. There are a lot of projects that may not have the ability to raise $100 or $200 million initially that actually will need that capital over the course of their life cycle to see success. And so we're seeing these projects start to move towards milestone-based funding, tranched funding, things that look a lot more like traditional venture capital in terms of their model, but from a very different set of investors. I'm going to talk about another trend here, the rise of securities tokens, which we see as a massive movement that is going to happen towards the end of this year and early next year. Today, this is what the token market looks like. You start with a technical token concept, something like a Filecoin or a Blockstack or a Definity, a really innovative idea that is building a protocol for the future of building what the future internet looks like. And those projects conduct an ICO, an initial coin offering. They raise money. At that point, the token starts to trade, it starts to be used, and you reach liquidity at the end of the day. And this is a really interesting market. It's a really big market. We just saw those numbers, 6 billion, 9 billion over the course of the last couple of years. But we think something really interesting is going to happen. We think that all assets in the world, real estate, equity, LP interest in funds, art, perhaps anything, could be tokenized. And that tokenization will then go through the exact same flow. Those same assets will be tokenized, they will have an ICO, they will start to trade, they'll see liquidity, and we'll see a number of benefits from securities tokens here. The size of that market is unimaginable. The size of the global real estate market, the size of the global art market, the size of the global startup equity market and private company market is so massive. We will always support those technical tokens, and they will form the underpinnings of the future internet. But on top of that, we're going to see this tokenization wave create a massive amount of value in even traditional assets. But you've got to ask why. Why securities tokens? Why do we need this? Why do we need to take assets that already exist and put them in a token? And here's just a few reasons that we like to talk about. The first, true, always open markets. A lot of us are in this industry because we believe in markets. We think markets are good, that they can drive towards efficient price discovery, that they can increase liquidity for assets that need liquidity. And the crypto markets, as you may have noticed if you've ever traded, are 24/7. They never stop. They don't take bank holidays. They don't take weekends off. The trading doesn't close at 4 or 5 p.m. And so the idea that those markets can always be on, can always be reacting to the news, and can drive towards more efficient price discovery is really appealing for a lot of these assets that are traditionally illiquid and don't trade in that way. Second, fractionalization. The idea that now, once we tokenize an asset, we can take it and you can buy 1/100,000% of it, or something smaller, instead of needing to buy in big blocks that are being sold by certain sellers in an illiquid manner. Having markets that allow for fractionalization is another element towards more efficient price discovery and more efficient markets. Third, compliance built in. Today, we rely on something called transfer agents most often for transferring hard assets or illiquid assets, where a person or a firm checks to make sure that a trade is legal. That is not an efficient way to run a market. And instead of that, we're going to see compliance built on top of these tokens, so that automatically, when a trade is happening peer-to-peer, the people are checked, the counterparties are checked to make sure that that trade is actually legal and should be happening. Fourth, access to liquidity. Illiquid assets need initial sources of liquidity. They need capital to come into those markets. What we have today, as we saw earlier, is billions of dollars of capital in the crypto markets, capital that desperately wants to diversify from these assets that they're holding that are purely high-risk, high-reward crypto assets and start to spread that money around. And if we can tokenize assets that have different risk-reward profiles, we can start to introduce liquidity into those from people that are traditionally holding significant amounts of crypto. And fifth, interoperability. Today, assets are not interoperable. If I want to move from one asset to another, I have to take that asset, I have to sell it for fiat, and then I have to move from fiat into the new asset. In this world, every asset will be interoperable. You will be able to directly trade one asset for another and conduct swaps in that manner. Again, all of this leading to more and more efficient markets. There's another category of securities tokens that we talk about. I was just talking a lot about real-world securities, about securities that exist in the physical world and we're going to tokenize. And I want to touch on one more example for where that could be really powerful. There's a vehicle called a real estate investment trust, or a REIT. A REIT is effectively when an institution goes and buys a bunch of real estate or a bunch of stakes in real estate and then bundles it together and sells interest in that fund that owns that to a number of parties that want to own it. So if you've always wanted to own a small amount of Berlin real estate, you could buy a REIT that indexes across a significant amount of Berlin real estate and buy a very small amount of it. And as the price increases, your value increases. As the price goes down, your value goes down. What's really interesting about these REITs is that the price you pay for them is more than the value of the underlying assets. Because there's a bank or an investment firm or someone in between that's doing work. They're buying up these assets, they're getting access, and then they're selling it to you, and they charge a fee for that. So you're actually paying more than the value of the asset. In this tokenized security world, if all the buildings in Berlin were tokenized, you can imagine going out and programmatically buying 1/1000% of every building in Berlin on the open market and effectively creating your own REIT for free without fees on top, without needing to have an intermediary, a middleman creating that REIT for you. And even better, if you thought you had some special information, if you thought you knew that a certain building was undervalued in the market or overvalued, you could buy more or less of that and actually create a really custom REIT instead of needing to buy the general one that someone is selling you and packaging for a large number of clients. It's this idea that we can create more sophisticated, more interesting financial products by tokenizing these assets is really incredible and will drive a lot of value in the market. But there's a second category that we think is really interesting. This is what we call protocol securities. This is taking something that is not a real-world asset and building a token that will be a security, that will be some sort of investment contract. So we're seeing a lot of examples of that. One is a project called SIA, which is a storage project. And they have a token that's used for transactions on the network that they call a utility token. Then they have a token on the network that accrues value, that actually will see an increase in value as the network is used more and more. And that's security, that's an investment. You're investing in the SIA network. It's not the token that's used for the transactions on the network, but you'll actually see the value start to accrue there. We think that is equally interesting and will allow for much more efficient management of cash flows in the future from these networks. Another example of that basis, formerly known as Basecoin, it's a stable coin. The value is always supposed to be $1 or perhaps indexed to something else. A $1 coin is not a good investment, it's always going to be $1. But they have created a second coin, a share token, on top of that, that as value accrues to the network, that excess value will be siphoned off to the share token. And if you believe in the Basis network, if you believe in the Basecoin network, you'll be able to buy that share token, and as the value goes up, you will see an increase in value in what you're holding. So I would look at both of these, real-world securities as well as protocol securities. Let's take a step back. We've talked about a lot, ICOs, security tokens. What should you be doing? First of all, we have to remember, it is the early days of this industry. I remind myself of this every day when I wake up. We have learned so much in such a short period of time, but there is so much left to be developed. We haven't settled on the final funding mechanisms for ICOs. We haven't settled on which assets are best to be tokenized. We haven't settled on the best models for securities tokens. We haven't settled on whether airdrops are the best way to distribute tokens. And so you have to remember it is early days and you are always taking risks in this industry. Those risks can come with commensurate upside. Second, think about this difference if you're going to get involved between technical and securities tokens, and perhaps within that, even breaking down those securities tokens into real-world assets that are being tokenized and these protocol securities. This is a big difference, and it's all kind of the same industry, but it feels like sometimes when we talk about crypto or the token market or the token industry, it feels like talking about the internet. And it makes sense, but it's a little weird to say, hey, I really want to work in an internet business. That's a really general term. An internet business might be Amazon, it might be Facebook, it might be CoinList. These are all internet businesses, and so to break it down like that, you need to get a little bit more granular. And when we say, I want to work in crypto or I want to work in tokens, start to think a little bit harder and say, do I want to work on a technical project that's a protocol building something really incredible to build foundations for the internet? Or do I want to work on tokenizing real assets or tokenizing some sort of protocol security? All very different categories. Third, talk to smart people. They're around and available. Again, a function of the market being so early is that everyone wants to learn and is really receptive to having those conversations. You would be shocked how often if you reach out to founders of top projects or top protocols, they'll respond and just want to have a conversation with you. Go to events, those people are there. This market hasn't matured enough for people to become too high and mighty to be involved with the entire community. And so even if you are just starting to learn about crypto, take the time, reach out to people and engage in those conversations. They are very often happy to fire back and forth with you. And fourth, kind of alluding to this, there are a lot of opportunities. This entire spectrum, protocol, technical, anything, securities tokens, there are a ton of opportunities, a ton undiscovered, and it is totally possible to have entirely novel ideas. There are not enough people in this space yet to have run the well dry in any sort of manner. And so think about it. Think about what the opportunities might be. Think about where the shortcomings are. Take the expertise that you've developed in your own industries, if you're not already in crypto, and see how you can apply it to the crypto industry. There is so much possible here that we have not even figured out yet. So with that, that's how we're going to fund the future, ICOs in 2018 and beyond. I'll stop for a minute there and we can take some questions.
Very cool. So we have a couple questions through the Slido app. The first one is, do traditional VC metrics really translate into the blockchain space? Which metrics are very different? I know you mentioned that.
That's a really interesting question. So, when VCs evaluate projects, they look at a lot of different pieces. And some of the things I put up there are some of the things they evaluate, right? So looking at the team makes a lot of sense. Looking at the market makes a lot of sense. Looking at the viability of the product makes a lot of sense. There are things that don't make sense. VCs look at, for SaaS companies, ARR, your run rate. Networks don't have run rate. The company doesn't make money from services provided to the network. That metric doesn't make any sense at all. And so when you start to look at the business model, that's where it looks really different. We would say basically everything is the same to evaluate between token networks and traditional companies, except for the business model. Because so often, especially for these technical tokens, their business model is that the project holds a significant amount of tokens, and as the network value increases, that value of tokens increases. They're effectively acting as an investment company, not a revenue-generating company, and they just happen to have invested in their own network. That's a very different business model, and any metric you look at that is based on revenue or profits or any sort of traditional business model probably doesn't make as much sense for token projects. The one caveat, of course, there are lots of service providers, CoinList included, that aren't their own token projects, that function a lot more like traditional companies that just happen to be applied to the crypto space. And in that case, obviously, all those traditional metrics do apply.
Maybe we have time for one more.
Yeah.
We have a couple here now, but the one that got an upvote was, how do you address current legal uncertainties regarding ICO's token across all jurisdictions?
Do we have another 3 hours for that?
Let's talk about America.
Yeah, America. Well, so I do think that, again, we're early. There's a lot happening. Regulators are taking, in many countries, kind of slow approaches and leaving a lot of gray areas, but at the same time not cracking down too hard and just trying to understand the space. I think that China and South Korea, a lot of projects that we're seeing are excluding China from their fundraising. Not as many are excluding South Korea. I think that was a little bit more ambiguous. In the United States, they've basically said all ICOs are securities. Not all tokens are securities, but all ICOs are securities. So if you're selling to US investors, you need to properly exempt or register the item that you're selling. But at the end of the day, the real answer to this question is, how do you address it? You get great counsel. You talk to lawyers who understand the space and the jurisdiction you're working in, and unfortunately pay them a lot of money, and then get the answers you need to move forward and build the protocol that you want to build.
Andy, thank you so much.
Thank you all.